Welcome to another premium market update today on the 7th of September 2022. Things do play out as we expected, right? We are below the best moving average, the best SMA here in blue, and the best EMA here in red. So those are the back-tested moving averages that worked the best in the past. We are below them, and so as anticipated, this medium-term positive trend, right, which got confirmed several times to the upside and the downside, it now broke. Now, how far can we in the very immediate future go? We can easily go down another $1,000 because that's what we have seen on the 18th of June, right? So retesting that low would not be a surprise. Can we then turn around from here? And could we just see like a double bottom, then go positive again? This very much depends on how the price develops during this time, right? If we go sideways for a while and then very sharply break upwards, right? We break then both moving averages again, then I would be more bullish again. But right now, things continue to look bleak. Bitcoin looks pretty much the worst. Ethereum doesn't look as bad, right? So this is Ethereum, and here we can see that this medium-term upwards trend has not yet been broken. But I also would not be surprised in case this actually does happen. So we've seen the EMA being a resistance twice now. So there isn't much to really support ETH. You can also see this actually when we look at Bitcoin relative to ETH, or ETH relative to Bitcoin here. This is Ethereum measured in Bitcoin. And let's look at this over the maximum time frame. And what we notice here is that Ethereum historically is at one of the most expensive relative valuations we have ever seen. Now, there is obviously a lot of hype around the merge. And people are buying that hype. There is a lot of news around Ethereum. More news means more attention. More attention means more purchases. But once the merge is over, right, and people see the gas fees are not being reduced, the adoption is not necessarily increasing, NFT trades are not going through the roof, the usage of the network isn't really changing, then all of this hype is likely going to turn around again, especially if all of crypto continues to go bearish, right? And there are a lot of negative points that points towards continued bearishness. So I think being especially cautious with Ethereum right now makes a lot of sense. Whenever something is historical, in the overall terms, historically expensive, historically cheap, you really need to have a very, very strong reason to bet against this overall picture. Now let's also look at total 3. So this is cryptocurrencies market cap minus Bitcoins and Ethereums. So this is looking at all the alts, and here also we broke below our support. And I haven't looked at this yet, but I do expect once we actually look at the stablecoin dominance that we will see pretty much a rise. Yeah, as expected, right? The stablecoin dominance rises when things go risk off. What's interesting around this is that we are not at all-time highs here, right? So when you actually compare this, there was a much higher stablecoin dominance on the 18th of June. When we compare the 18th of June here in Bitcoin, of course, the price was low, but now the price in Bitcoin is even lower. But the stablecoin dominance is not at an all-time high. What does this mean? It means simply that capital was completely exiting the system, was completely exiting crypto. So it wasn't just short-term speculation that's happening over here. It wasn't just people that thought, okay, short-term we are going down, thus I move my money into stablecoins. It's actually people even reducing their exposure to stablecoins themselves. They're really withdrawing fiat from the crypto ecosystem. The entire ecosystem is basically shrinking in size. Now, when we look at the top 100 cryptos and we look at what happened in the last 24 hours, there are, of course, not a lot of great gainers, right? I would not start speculating in a failed stablecoin. So forget about this. Too risky. The risk versus reward isn't really worth it. You can see here Lido DAO is crashing quite a bit. ETH Classic, interestingly enough, is also crashing, which is the proof of work kind of ETH, right? Some people are expecting that some miners might move from the regular Ethereum to ETH Classic. But ETH Classic's market cap isn't really that large, right? So what's more likely to happen is that people simply just stop mining altogether and they're going to sell their GPUs. So if you're in the market for a GPU to play video games or to do video editing or whatever it is, I do expect quite low prices for those chips in the future, at least for a few months. There are, of course, still these supply chain issues, etc. But there's a lot of GPUs tied up in mining that will then be shut off. And they're definitely not just going to another chain because there's simply not enough capital locked up there. So it's not really worth it, especially with the rising electricity prices. Now, what does does this all mean in the macro sense? Let's look at a few models. And a quick reminder here, not all models that worked in the past are going to work in the future. This, for example, here is the stock to flow model. And a few months back, I think it was like half a year back or so, I made a video on the public YouTube channel as in what I think of this stock to flow model and basically my critics around this, right? Because it basically anticipates a 10x every 4 years with the halvening, because the circulating additional supply, so the supply growth, being cut in half, right? So Bitcoin becoming more rare, as in the flow is becoming lower, and thus this additional rarity should justify higher prices. And that's simply just by cross-asset analysis, as in how much additional flow is there for silver and for gold, what are their market caps, so what kind of a market cap should we then expect for Bitcoin if the additional flow every year is comparable. That's the idea of the model. We can see the delta here between the projected price and the real price is really spreading. That's simply because the stock to flow model just looks at supply and does not look at demand at all. And really the deviations from this model price are simply just demand driven, right? Is there more demand for Bitcoin or more supply? And the demand is fluctuating way more than the supply. So it makes way more sense to actually focus on the demand side, not so much on the supply side. Even though, of course, over decades, additional token inflation, etc., all make a lot of sense to look at, right? Or if you look at altcoins like AVAX that inflate by 25% or so per annum, of course, then it's relevant. But if Bitcoin inflates by 2% or by 1%, doesn't really move the needle much. So focusing the entire price projection just on the additional supply, I think does not make a lot of sense. And of course, at some point, this model has to break, right? We can't 10x into infinity and then get Bitcoin basically tying up all of the liquid capital. So for me, it's not really a surprise that this model is breaking. Now, what is a bit of a surprise is that the 200-week moving average is starting to get some serious testing. So when we look here at the Mt. Gox crash in 2014, right, 2014, 2015, we then in the end got our bottom here. We also not necessarily directly bounced off, right? We are fighting here for a short period of time, here again, and then we got a pretty massive rally, which then happened from like $230 all the way to $400. Okay, so we have seen prolonged tests like this before. Also, when we look in the 2018 crash, so this was over here, and the Corona crash, we did have a few days below that moving average. But when we look at the current situation here, it does look a bit more worrying, right? We haven't seen that much of a deviation yet in relative terms, right? The bottom should be 23K, but we are now way lower than that. We'll basically have to instantly bounce off here again for this model to continue to work. Will this be the case? Nobody knows. I actually like this model quite a bit because the growth can slow down in case we are not accelerating too much and if you just go sideways. So the growth is not necessarily always at the same pace. So I do like this kind of adjustability of the model, but let's see actually if this plays out the way it does. I also want to show one model that definitely pretty much broke now, and that's one of the logarithmic regressions. So different kinds of regression lines, right? This is one of them. So this is from lookintobitcoin.com, and see how in the past we really traded very well within those bands. Just during the Corona crash, we have been briefly below it by roughly a third. So the lower band here was 7.5K and we went down to 5K, right? So 1/3 below that. But currently, this is quite different. So the lower band here is at 40K and we are at half of the size. So we've never deviated that much from the model. So even things that tended to work quite nicely in the past are no guarantee that they will work in the future. What I found interesting is when we look at a different kind of regression that ignores these extreme hype scenarios, it's a bit less optimistic. We are still within the bands, but there's actually two websites for this. So there is this Look into Bitcoin rainbow price chart, which by the way was published afterwards. This was the very first version of this. This is from blockchaincenter.net. And in blockchaincenter.net, we are pretty much here at the bottom, right? We can't zoom in on this chart, but we can see we are pretty much at the bottom. So this tells us now that we should really buy. It tells us we are basically at a fire sale right now. Now, when we look at the version from Look into Bitcoin and we zoom in over here, we are not yet at the bottom. Here, the bottom is at 16.5K. So it seems like the model is not completely the same on both of those websites. Here we've got a bit more way to go. Here we have already reached the bottom. Now I will tell you my thoughts around this regression afterwards in this video. But let's first continue a few more models. So this is the PUL multiple, again in the green area. Looks relatively good, right? Looks like we should buy heavily. Here is the market value to realized value z-score. Also pretty low, right? We are below the realized value. So that was also a relatively nice floor indicator in the past. And then we've got the 1 year plus hodl wave, as in what percentage of all of Bitcoin is held in wallets that haven't moved their Bitcoin for at least 1 year. That's what this is showing, right? So currently the quote unquote long-term holders that hold at least for 1 year, currently 66% of the overall market. So only 1/3 of the Bitcoin is actually being actively traded, which tends to be a good thing, right? Because it means there's less liquid supply. So when the supply is locked up in long-term holders, that means that potentially with this little supply, an additional wave of demand can push up the price quite a bit. So when we are here at an all-time high, that's good. It's also nice that this 1 year hodl wave tends to increase over the years. So Bitcoin becomes more and more of a long-term investment for many people, right? We've never seen such a high value. That's in general positive. Now, does this all mean we have to sell our house and go all in on Bitcoin? Of course, we have to risk manage, right? We have to diversify. There is unfortunately quite a bit of correlation now across risk on assets. So no matter if you hold tech stocks or you hold Bitcoin, they probably go pretty much in the same direction. But for the Nasdaq, it's at least not that bad of a drop yet. But I want to give this whole thing, all these models here, I want to put them into perspective, because what we see over here is now the Nasdaq on a long-term chart, right? So this chart starts in 1985. Okay, so over here, we also have the dot-com bubble and then the massive crash from the dot-com bubble, right? So that was a 83% crash roughly. And the vertical line that we see over here, that's actually when Bitcoin was introduced. So Bitcoin was born out of the global financial crisis, right? The crisis that was triggered by all the cheap lending that happened, all the weak lending in the US, right? Where we had the mortgage-backed securities. It created this crash and then Bitcoin was born. And since then, all we have seen is this kind of a move in the Nasdaq. So of course, when stocks go this direction and you put some regression models around this, then now looks cheap. But this doesn't mean that this is the maximum degree of pain that we can potentially see. We have seen way more pain in the past, twice actually. And these are simply deleveraging events. This was a lot of speculation, similar what we've seen 2017 in crypto with the ICO boom. So this crash here makes a lot of sense. A lot of companies that didn't make any money simply just put .com in their name. They got bought up. So this was simply just a greater fool's game, maybe also similar to nowadays, the NFT market that crashed. This here was a real finance-induced crash. Now, I don't expect that we're going to see something similar to the .com crash again, simply because the nature of this crash is very, very different. The nature of the current crash is simply just macro enabled, right? It's rising interest rates, it's reducing globalization, it's higher energy prices. But seeing something similar to the GFC, right, to the global financial crisis, is maybe not completely unimaginable. So let's take exactly this movement and overlay this to today, right? Let's zoom in and let's look at what actually happened in the grand scheme of things. So far, we have come down in the Nasdaq, maximum pain, 33% roughly. But when we then take that low and we look at the global financial crisis kind of a low, it's another 30%. So if we see something similar to the global financial crisis, where then the Fed would see that they have no other choice but to ease and to basically live with high inflation. If that kind of a game plays out and we see maybe the unemployment rising, etc., then what we have currently seen in stocks is only half the way down. And if the correlation prevails, the strong correlation between Bitcoin and tech stocks, maybe what we have seen here in Bitcoin is just the beginning. And maybe all of these models here will break, because all of these models, they assume that the game, which was played since 2009, simply continues, which it does not necessarily have to. So what's the takeaway from all of this? Nobody, of course, can predict the future. We simply need to be aware that no matter what kind of sophisticated, formulated opinion you have on the market, there is a good chance that you might all be wrong. We do see a lot of dangerous signs. We do see how inventory for houses is going up, how prices are falling across the board, not just in the US, but even in Germany. In Hong Kong, it's no different. We do see a lot of pressure on households. They can't invest as much anymore because of the rising energy prices and inflation in general. And we also still see the Fed that's not really in the mood of relaxing anything. So the overall macro environment still looks very, very hostile. That being said, just selling everything, hoping to be able to buy back lower again is also pretty tough because you have to time this twice right? First of all, you have to time this right with the selling, that we are really not just bouncing off here, because maybe there will be some kind of a surprise, right? Maybe suddenly the Fed will instantly turn around. But if we actually do fall further, you also need to time this correctly in picking the right bottom. And that's probably even the harder of the parts. So my approach to this is simply, again, continue to diversify across asset classes, try to lose as little as possible, and of course, learn a lot. Try to get an edge at least in the market, right? Learn on-chain analytics with Dune Analytics, the tool that we discussed quite a bit in prior market updates. Also learn how to build trading bots so that we can at least outperform and maybe increase our crypto portfolio measured in Bitcoin. Simply just go with a different approach than in the bull market, right? Don't just go hunting for altcoins, but become more knowledgeable than the average market participant, because that's in the end the way how to outperform. Where should the outperformance come from, if not from skills and from knowledge? And so that's what we do always here, right? I simply wanted to dedicate this market update just to this overall picture. If you have a time horizon of say 2 or 3 years, then I do think the current prices for Bitcoin are really great. If you are considering to buy now and hopefully flip this in a week or two, then I would definitely rather stay away from this. And instead of trying to make these kind of risky plays, just use all the time to learn how to find new projects, how to analyze them properly, so that when actually the next bull run does come, that you're not just simply looking at random tweets or at random YouTube videos, but that you actually have a system in place to beat and make way more money than just the appreciation of Bitcoin itself. I will publish this premium market update also on YouTube. So in case you're watching this on YouTube and not within the premium membership, then feel free to check out thebitcoinstrade.com. We do updates like this every single day. We analyze altcoins, we look at on-chain data, and we write trading bots, all very advanced topics. So if you really want to dive deeper into everything and you don't just want to look at what might Bitcoin do tomorrow or the day after tomorrow, if you really want to improve your skills, that's the place to go. It's currently $75 per month, but if you've got $3,000 or $4,000 to invest passively on the side, then you can instantly recoup that as well. So feel free to join us, and I will show you how to actually get this done. Thanks again for watching, and see you next time. Bye-bye.